So welcome back to the webinar. Fridays and Mondays are webinar days organized by Princeton's Bendheim Center for Finance. We're very glad to have Paul Krugman with us. Hi, Paul.
Hi there.
Paul was my colleague for 15 years here at Princeton and now is at CUNY, and everybody knows him not only as an economist, but also a New York Times columnist. And he probably has the best title of any webinar talk so far. It's called The Audacity of Slope, and we will be surprised what will be behind this title. So as usual, I would like to go back a little bit and give you some views what will come up. So Jeremy Stein was talking on Monday about the Fair Treasury credit programs and relating it to, the venture capitalist of last resort idea he proposed. And on Monday, John Cochran will talk about the economics of reopening. And we have many more speakers coming up the subsequent days, always Mondays and Fridays. So we have three crises, and today we will talk about the health crisis, in particular the economic crisis. That's what we're focusing on. And I like this picture here, where you have the COVID crisis coming, and everybody says, be sure to wash your hands and we will be well. And then you have a second wave coming, which is the recession. And we will study today, we will learn more about how severe the recession will be, how long will it last, and how much do we have to fear it, or we can actually avoid some calamities. So I want to start with the Friedman blocking model. Essentially, I have a guitar here on the side. That's the idea. You pull on the string and then the economy bounces back to the old growth path. And it's essentially, in log terms, it's a linear line, and the slope reflects the growth rate. And this was a good characterization of the economy in the United States. It didn't really was a good characterization internationally for other countries, but from the 1960s or mid-60s to 2008, it was a fairly well description what's going on in the United States. And we put in a plug for a paper by Dubratz, Nakamura, and Steinson, who actually analyzed that in this particular paper. Now here I have plotted the real data, and you can see, there was a sharper increase after the Second World War in the 50s and the early 60s, but then the growth rate in the long run was pretty stable. Of course, there were all these wiggles, the business cycles here, but the growth rate was essentially the important component. One striking feature is, of course, when you look in 2008, that you see a departure from this long-term growth rate. There's a drop in levels, and there's also a slowdown in slope. So you have two breaks. Two structural breaks. One, the level, you don't come back to the old growth rate, and also then the growth rate subsequently, the slope is actually lower after 2008. And here I just zoom in on this particular photo and this particular picture. You see, of course, here the late 1999, 2000 NASDAQ bubble going on here. You see the housing bubble didn't really do much for GDP in a sense, but you see this huge break here in the financial crisis, where you have then a drop in the trend line, and on top of it, the slope will be lower as well. Now the question is the audacity of what slope, and what slope will Paul talk about? And so of course I've plotted here in a stylized fashion again what we had. We had the drop here, and we have a lower slope here. But of course there's one slope, which is how fast will we decline here. So how fast will it drop here, the red line here. And then there's another slope saying how fast will we come back. That's a green dashed line. But of course, here what I've plotted here, perhaps a little bit pessimistically, that there will be a W recession. Then you can have another decline subsequently if you open up too early, if mistakes are made. And then essentially is the other slope could be the blue dashed line here. Or we're focusing on the long run purple line here. That's another slope here. So there are many slopes floating around, and we will see which slope Paul has in mind later on. This reminds me a little bit, so that the long run trend is also important. What will be the long run trend? We have no clue about this. Will it be similar to the 2008 crisis, that we actually have then a drop in the long run? That's what Paul Roma claimed earlier in an earlier webinar. We might fall back. If we don't intervene fast enough now, we might fall back to a lower trend line, and actually with a lower slope potentially, like we did in the 2008 crisis. And that's the dangers we potentially fear. Now this long-term trend there are some arguments that, you know, we have some long-term trends anyway, and what COVID does, it speeds up these long-term trends. And it just makes everything much, much more faster. So instead of going down this way like this bicycle rider, we just drop down and then, you know, have reached this new long-term trend much earlier. Of course, there can be negative trends and positive trends. Let's focus on the positive side too. There will be home office, there will be telemedicine, other innovations which will be speeding up, and the implementation will be sped up. But that's essentially what Tyler Cohen in his earlier video was talking about. Now, what are the different shocks? So once you have a shock, a recession shocks, and what are the amplifications? Of course, there's always potentially a pre-crisis buildup of bubbles and imbalances, but then you have different shocks, and then you can classify these shocks in different ways. One is it a temporary shock or is it a permanent shock, the underlying shock? And then the second question is, once there's a shock, how much is the system amplifying the whole thing? What are the feedback effects? What are the spirals, nonlinearities, and so forth? Amplifying it. So the first initial trigger, the initial shock, can be temporary or permanent. There can be a supply shock or demand shock. In the 1970s was more supply shock. Recent crisis in 2008, 2009 was more demand shock. The current crisis is potentially a mixture of both. Or it can be an aggregate shock or some idiosyncratic shock. So idiosyncratic risk is going up from a finance perspective. I will focus today much more on this temporary versus permanent aspect, whether, you know, there will be a V, U, or L-shaped recession. And then there will be amplifications. There will be move from a risk on to risk off environment, flight to safety is kicking in. That hits particularly the emerging economies. There will be runs and spirals if the Fed is not intervening sufficiently enough, and there is probably the danger of multiple equilibria on top of it. So what's the optimal policy if there might be permanent or temporary shocks? And in particular, if you don't know whether it will be permanent or temporary. So you have to learn, you know, as we go along, what type of shock we're facing. And Olivier Blanchard, when he gave his webinar in this series, he characterized the crisis into two phases, which stuck in my mind. He said the first phase is when policymakers acted, let's say, whatever it takes phase. So they do everything, they throw everything at the problem. And then there's a second phase, which is, oh my God, what have we done phase? So these are two interesting characterizations when he was, you know, chief economist at the IMF, experiencing how policymakers reacted and had then this two-phase reaction. You might get a backlash saying, okay, we should actually not react whatever it takes, because suddenly it kicks in that there might be longer and consequences if you interact, or if too little, too much, or not at all. So when you have if you don't know, if it's temporary and very short term, and concepts like short-term work, like Kurzarbeit, is very, very beneficial because it reduces the damages to break up relationships, corporate relationships, and you maintain them. But of course, it also reduces the potential of building up the new environment, to adjust the environment to we might have fewer restaurants and much more online deliveries and so forth. So retail sector has to readjust much more to online delivery. And I'm very impressed how the private sector is adjusting so fast and so flexibly. So it's a very impressive period from this perspective, how agile the economy is in the United States or also in other nations. And that's it's very impressive how people react to this change of nature. But in general, we have this uncertainty, whether it's a temporary or permanent shock. We want to get a clearer picture, and I hope Paul will help us on this today. And how should we then deal with it in terms of policy measures? One aspect is, okay, let's just have policies which are very flexible, or let's have policies which are contingent on certain outcomes to the extent we can foresee the contingencies. And that's really related to what Jeremy Stein was talking about with respect to the Fed and US Treasury policies, and arguing, you know, it should act like a venture capitalist, stage financing and then adjust subsequently later on. You can also extend guarantees, which, you know, give some certainty. But the problem is, if the policymakers have too much flexibility, there's also a lot of uncertainty left for the citizens to bear, and there's less planning certainty. And that's essentially a trade-off you want to have as a policymaker, a lot of flexibility to react. You learn more about the virus and so forth, but it gives less certainty for the real economy to plan accordingly. There's a trade-off here as well. So one big question, of course, is whether it's a temporary or permanent shock. What are the implications on inflation, on deflationary pressures? I've built a model on this with Sebastian Merkel, Jonathan Payne, and Yuli Sannikov. We presented this on Monday in the competing webinar series organized by Virtual Macro Seminar. And that setting, essentially, the length of the pandemic is random. It's exponentially distributed. And then the question is, will essentially inflation set in or deflation? It depends very much how long the whole pandemic is, and also on the redistributional measures the government undertakes. If there's more redistribution and you balance essentially the inequalities, it reduces deflationary pressures and so forth. So with this, as usual, I would like to conclude my introductory remarks with a little poll. So all of you can participate and figure out and give us an idea of what you think before you hear Paul's argument. What do you think? Do you think the recovery scenario, it will look like more a V-shaped recession? So we're going down very sharp, but we will come back very sharp as well. Or will it be U-shaped? We go down, stay there, and then come later back down, or even L-shaped. It will stay down all the time, or W-shaped. There will be a second wave. There's a first wave and a second wave, and there's a recovery, then it goes down again. And the second question is, when the whole COVID crisis is over, when the vaccine is discovered, will we live in a different world? Will the economy be fundamentally different? Or will we go back to the earlier phase, the way we have organized our economy beforehand? So let me just let the poll run a little bit. And I see as the votes are coming in, I can give you some hints. I hope I don't bias you. It seems like the majority thinks it will be a W recession. 44% at this stage think it will be a W recession. And then the second highest is a U-shaped, 30%. L-shaped is 20%, and only 6% think it will be a V-shaped. Concerning the will we return to the pre-COVID economy, it's roughly split. So it's 52% think we will return, and 48% think we will not return. So that's essentially what we are seeing here. So with this, I conclude my opening remarks and pass on the floor to Paul. I have to stop by sharing my screen, and Paul is sharing his.
Okay. And hi, so let me talk for just a minute before I start sharing slides. Hello, everybody. So this is a, we're in a funny situation where a lot of, I gather that a lot of the other presentations have also, like mine, been, if you like, a little bit lowbrow, or at any rate, not rising to the kind of thing one would have presented at a seminar in that long ago period when we weren't all shut up in our houses. So I'm not going to present a formal model. I'm not going to present detailed data analysis, basically because I'm in a different situation right now and I'm trying to do a lot of real-time commentary. I'm going to try and think about the issues here. Just to say right away that I would not have chosen any of the letters that Markus presented. I mean, almost by definition, at the best we can hope for in some form is as people have been saying, a swoosh-shaped recovery, like the Nike swoosh with the big down and then a more gradual up. And my question really is about how fast. And the reason, actually, now let me do some screen sharing. So the reason I say that, so there is that, look, this is monthly changes in employment. And if you're going to have 20 million lost in a month. We're not going to have a month of 20 million job gains. So it's the ascent has to be slower than the descent. The question is whether, how fast. I didn't actually give you a chart with the swoosh in it, but how fast is the return? And the answer is highly uncertain. It's what we're trying to figure out, and it depends on, unfortunately, it depends not just on the economics, but also on the virology, on the epidemiology. So it's a much more it's got levels of stuff that we don't know about that go beyond what we usually have to cope with in economic modeling. I will also say that Markus in his remarks focused a lot on GDP. I mostly think about employment rather than GDP. Partly that's because in terms of, first of all, this is kind of a technical issue. If you're looking at history, business cycles are not actually all that, it's not clear that GDP doesn't have a unit root, whereas employment pretty much does, and the unemployment rate certainly does. Sorry, does not. Anyway, there is clearly a mean reversion in unemployment, and the question of exactly what happened to growth after 2008, why we seem to be on a lower growth path than we were before and then was anticipated, that's a whole other question. I'm not what I'm going to talk about here. So the issues that I'm concerned with are basically how fast can employment return, there is, first of all, the question of just what is hitting us, and there have been some efforts at modeling here, that real modeling, seriously trying to cross all the T's, dot all the I's, and which have informed what I'm doing. It's amazing, actually, that people have been managing to get anything out in time. We're living on COVID time. Things that would normally take a year or take a week now. And so in a way, even what I'm about to show you have been overtaken by events. These are the two papers that had a fair bit of influence on me in the last couple of weeks. One is the Guerrieri et al. Paper, which is principally concerned with whether the initial shock caused by the lockdown then propagates into a second demand side shock in the rest of the economy. Whether you basically this is greatly oversimplifying, because it turns out you need to worry about intertemporal substitution of various kinds as well. But the question is whether the fact that a bunch of people lose their income because activities of certain kinds are banned, then leads to a Keynesian shock to activities which are allowed. So that was their major concern. Caballero and Simsek have a different concern, which is about the financial sector, whether you get a spillover from financial losses in, again, COVID-affected sectors that leads to the closing up of financial markets or widening spreads even in sectors that are not affected. And it's a very Markus talked about risk on, risk off. Theirs is actually not. Theirs is very much a balance sheet issue. They imagine that there's a limited set of risk-bearing actors in the economy, and who are highly leveraged and constrained by their net worth, and so that losses in one sector can propagate into financial disruption in others. Talk about both of those in a second. I'm just going to say one more. This just hit my virtual desk this morning. I just skimmed it, and it's an argument for in terms of labor market search, arguing actually that it will be a protracted, slow recovery because so many workers have been severed from their job relationships. I'm not sure what I think of it yet, but just to say that there are people. And I'm going to, let me just read the sentence at the top of this one, and then go back to go back to myself on the screen, that the theoretical models that are out there so far don't really have dynamics. They use what I'm calling the two-period cheat, which is fine. I should prove it because it's actually one of my own specialties. I'm not sure who invented it. Certainly when I wrote about liquidity traps and all that more than 20 years ago, that was the way I did it, which is, and the two-period cheat is you actually have an infinite horizon model, but you assume that you have a shock in period 1 and that everything is back to long-run equilibrium for periods 2 through infinity. And so although the model formally is infinite horizon, it's as if it were a two-period model, and in fact, and all of the action takes place in period 1, so it actually almost looks like a static model. And that's a way to reduce potentially complex dynamics to something that is much simpler, which is great. I think it's a very good strategic simplification. But events are moving so fast that it's kind of not what we want to. We know that that's not how the world actually works, and or we suspect it may not be the way the world actually works. And so our problem is, how do we deal with the how do we think about what comes after the shock? And that's, the models like that can't answer it. Ricardo Caballero says that he's working on a continuous time version, but I'm not sure what that means. It might be something like what Marcus showed with the stochastic end to the pandemic, but in that case, it's not. It's still going to suffer from the same incompleteness, the absence. As I said, the models we have right now don't have intrinsic dynamics. There's just the shock, and then the shock is over. And what we're worried about really is what happens. Does everything go back to normal quickly after the shock is over, or does it not? And the reason that this becomes especially urgent is, so I'll give you again my screen here. Move ahead to, so Ernie Tedeschi and some others have been doing, using various sources of more or less real-time data. We're actually now at the point where we kind of want daily data. But what they're kind of suggesting is that, and multiple sources are suggesting, is that it looks as if, period 1, the period of the shock, is kind of, not that the shock has gone away, but we've already seen what these effects are likely to be. That's not totally fair. We don't really know that, but it's, there is, if I can say, not much sign in the available data that there's been either much Keynesian spillover from the lockdown sectors to the rest of the economy, or that there's been, that there is at this point a lot of financial spillover to the economy as a whole. It's the concern, the kinds of issues that the existing literature, this is really weird, the existing literature is 2 weeks old, the kinds of concerns that the existing literature deals with are kind of behind us, and we have new concerns looking forward. Now, that's not an accident. It's not that those concerns, that people were wrong to raise those concerns. The reason that it looks like we probably did not have very much either of a Keynesian or an asset market spillover is that policy has largely offset the potential damage, not completely, but largely. So going to do our screen again. This is a more awkward process than we would like. Okay, so lots of things we didn't know, like to think about, but we're all becoming kind of instant simulated experts on things like what do unemployment insurance claims mean? You still have a lot of newspaper stories, actually, as of yesterday, that add up all of the new claims for unemployment insurance and say, 32 million jobs have been lost. It turns out that historically, summing up UI claims that way is not, it is a predictor of job losses, but you would think that the coefficient would have to be more than 1 because not everybody is entitled to unemployment insurance. In fact, the coefficient is considerably less than 1. And that's probably because people end up applying multiple times because they've been turned down or whatever. But for whatever reason, that's actually less than 1. Continued claims, the number of people actually receiving unemployment insurance, on the other hand, has historically been substantially less. Not only has a substantial number of people who are unemployed as counted not receiving unemployment insurance, but even the movements have been substantially less. So that if you look at the at what happened during the Great Recession, there was a big expansion in the number of people covered by unemployment insurance, but it wasn't remotely as high as the number of people who became unemployed. This time around, now, if you look at the current reports, it actually looks as if the growth in unemployment insurance claims has actually been greater than the growth in unemployment. That's probably reflecting the fact that the BLS has undercounted unemployment. And they themselves say that. If you read the report, they say that because they believe that their field people tended to classify people who are not working because of COVID as still employed, and that the actual unemployment rate is probably closer to 20 than it was to the 14.7 reported. But it's still clear that there's been a big increase in coverage, and that's reflecting in large part legislative action. We had an expansion of the coverage of unemployment benefits, and we also had an expansion of the generosity. And while it's taken a while, there were some significant lags in unemployment offices were overwhelmed. Actually, we were talking before this was opened up about the state of New Jersey was desperately seeking COBOL programmers because their unemployment benefit system is so old that it has mainframes that run on COBOL, which nobody under the age of 60 knows. But they've been catching up, and there's just this morning I saw that the Hutchins Center at Brookings believes that for the month of April, about half of the income loss from loss of employment was offset by enhanced employment. The unemployment benefits also became extra generous, an extra $600 a week, and that about half the income loss was offset, with that rising over the course of the month. So we probably actually have had a fiscal safety net extended to people losing income that has made up much of the loss in income, and there's therefore, among other things, contained any possible Keynesian spillover. And in terms of the asset markets, so give you our next one here. This is from the Liberty Street blog at the New York Fed. They were focusing on commercial paper and money market funds, but basically massive Fed intervention. And some of it of actual large-scale purchase of assets, some of it mainly promises that they will, if necessary, buy assets. Even junk bond ETFs have contained the surge in financial market spreads. In a lot of ways, and Marx is using whatever it takes. If there's anybody who doesn't know, that's the famous, Mario Draghi said 3 words and saved the euro. As he said, the ECB would do whatever it takes. In effect, the Fed has already had its whatever it takes moment with regard to asset market disruption. And so Ricardo was not wrong to be worried about that. And for a couple of terrifying weeks in March, it looked as if that was happening, but it appears to have been contained. It's funny how we're using that contained became a kind of a joke in 2008, but it's once again, but it does look as if really aggressive Fed policy has limited. So the models that say, okay, we got a shock to one sector because of this crazy new threat that forces us to do a lockdown, how much does that spill over to the rest of the economy, are important and interesting, but actually are not telling us where we're going. They're telling us where we already are. And so looking forward is a different question. Okay. recovery. We really don't have, as far as I can make out, we really are lacking in models that make sense of that tell us how about the pace of recovery. We have metaphors, ideas. I was actually going to mention Milton Friedman's plucking story. Certainly for employment, that's what a lot of us tend to think of. And the plucking story would say that you would tend to return to the original level of employment, which has been true, but it doesn't actually tell you how fast. What it does suggest is that how fast you return would probably depend, the speed of employment growth would probably depend upon how deep you went. So if you have a steep slump, you should expect a rapid return. However, that's not actually what the history suggests, at least not in that simple a form. And so I'm going to give you, again, here's the kind of slope that I'm concerned about. So this is the last 6 economic recoveries where I'm giving you the year that was the bottom, the trough of the recession. In doing this, I'm counting, for those who follow such things, I'm counting 79 to 82, which is officially 2 recessions as a double dip recession. The slope I have in mind is the slope of these lines. They're the pace of employment growth during recovery. And what you see there is that there are, they're not all the same. They fall into 2 broad groups. There's a period of, those are the V-shaped recoveries at the top. The recovery from 70, 75 and 82, and the L-shaped or U-shaped or whatever are the more recent recessions. Hoping that people will be able to keep that in mind, because I don't think staring at a slide and listening to a voice is optimal as so far as we can control it. If you look at it, it does appear that the dynamics of recovery changed quite a lot after 1990 or so. Not everybody appreciated that in 2008. There were quite a few people who basically had some version of a plucking model in their minds and thought that, well, since we've had an extremely steep decline, we're going to have a rapid rebound. But the others, I have to say, including myself, thought that this was not right. That we actually have had, as of if you asked me about it just a few months ago, I said there are really just 2 kinds of recessions that happen, but there are 2 kinds, and then now we have something which is quite different, but the question is where it fits into that typology. And the 2 kinds are recessions that were basically generated in the first instance by the Federal Reserve. Sorry, the US centered, although I think that would apply to other countries as well, that were basically generated by tight monetary policy. The Fed raising rates to squeeze the economy because of inflation concerns. So that was what happened in the 69-70 recession. It's what happened in the 74-75 recession. It's what happened in the 79 to 82 double dip recession. Then you have a second series of slumps, which all were very, very different. So let me actually just give you quickly the Fed funds rate picture, just to give you, if you look, it's kind of what you know, but if you look before all of those previous recessions, there were large increases in the effective federal funds rate, gigantic in the case of 79 to 82, that preceded the recessions. And then very large falls in the interest rate afterwards, partly because you could. And basically once the Fed deemed that inflation was under control, it loosened. Okay. That's not, although there was some interest rise before more recent recessions, it was much more modest. It was the Fed tapping on the brakes as the economy appeared to be approaching full employment. There wasn't anything like the extreme squeeze that was generated in previous recessions. What happened instead was that all of the last three recessions were generated by some kind of private sector overreach. The people overextended themselves in some way. 1991, which is a long time ago now, my God, it was a little bit complicated, kind of a mix of stuff, but probably the biggest component was overbuilding of commercial real estate. 2001 was the dot-com bubble and actually a lot of overinvestment in telecommunications, which was probably actually more important than the dot-com bubble. So it was more the laying too much fiber rather than pets.com. But anyway, there was again and then of course 2008 is the housing bubble and the burst. And what you used to call postmodern recessions, which actually look a lot like pre-World War II recessions, have tended to be the private sector gets carried away. Inflation has not been a problem. So this is the era of controlled, of anchored expectations on inflation. So the central bank hasn't felt the need to really squeeze the economy hard. It's allowed the private sector to run, and private sector runs on for a while, and the unsustainability of what it's doing is masked by a bubble or something. And then there's either what the Minsky moment, or as people sometimes say, a Wile E. Coyote moment. Because I've noticed a lot of international people popping in here, so you may not know, but the old cartoons with Wile E. Coyote chasing the Roadrunner, and invariably he would end up running off a cliff. And under the laws of cartoon physics, if you run off a cliff into thin air, you don't fall until you look down and realize there's nothing under you. And so that's, we've had those kinds of recessions. And it appears that that those are much harder to end. Partly because certainly in 2008, that there was less room for the Fed to cut to start with, but also because you're trying to, instead of having imposed extreme pressure on the economy through high interest rates, and then you take away, and then the economy springs back, you have a situation in which the private sector has overextended itself, and you're trying to induce extra spending in other areas to offset the spending that has gone away. By the way, obviously, I'm giving you a demand-side view of what recessions are about, which I think is crazy not to, by and large. But anyway, that's you have it appears that recoveries from these overextended. Oh, actually, sorry. I just want to mention although I don't know if anybody's actually read Minsky in full. But the phrase Minsky moment comes from Paul McCulley. It used to be at PIMCO, and he said rather famously at the beginning, in the 2001 recession, the Fed needs to create a housing bubble to offset the loss of the tech bubble, and which is basically, and which it managed to do. But it was, aside from the fact that stored up problems for later, it also was hard. So the recovery from, although 2001 was not a deep recession, it was a sluggish, extended, jobless recovery. Part of the issue, I'll just give you quickly this slide. I have my doubts actually whether I should have included it, but so yeah, the Minsky Wile E. Coyote moment. If I believe, which I mostly do, the work on leverage as a major source of the last recession, then we came in having accumulated levels of household debt relative to GDP that were extremely high by historical levels. And that left you with an overhang of of problems to be resolved, which helps to explain the sluggishness of the recovery. And so that's the story that I would have had. And then so historically, we seem to have two classes of recoveries. V-shaped recoveries following, well, historically monetary policy induced recessions, but I'll try to argue in a minute that there's a slightly more general version of that. And then much more sluggish recoveries following recessions generated by private sector overreach. For what it's worth, that's not just hindsight. Some people did warn that recovery was likely to be sluggish from the 2008 crisis. Actually, even before it had really turned into a full-blown crisis. So the upper left one is the famous Reinhard Rogoff, not the other one about 90% of GDP, but the one that really nailed it, saying that recovery from financial crises tends to be slow, warning that that would be the case again, and with less data analysis by a factor of about 1,000. For what it's worth, I was saying the same thing at the time. So there was kind of this vision that there are different kinds of recessions that have different kinds of recoveries actually made a successful out of sample prediction. Not everybody did that. I don't know if anybody remembers this, but the two very fine economists, Christy Romer and Jared Bernstein, when predicting the effects of the Obama stimulus plan, they got a lot of grief over having been over-optimistic about employment growth. And people said, see, stimulus doesn't work. But it turns out their without recovery plan also had a fast recovery in employment. And that the actuality was slow. And basically, they were, like a lot of people, were going with some version of, implicitly with a plucking model, where the further out you pull the string, faster it springs back. And that's not what happened in the past. Okay, so my question is, those are the lessons of history, and of course we've now had a historically unprecedented slump. But that doesn't mean that unprecedented both in speed, but also in cause. That doesn't mean that the history is useless if we can find the right mapping from the historical experience into this current crisis. Then it may be of considerable help. And so I have a hypothesis, which I'll share with you in a minute. And it obviously could well be wrong. And furthermore, we may not even get a clear test, but that doesn't make me sound like something worth hearing. But anyway, let me try it.
I interject with a few questions now.
Oh, you want to give a, sure. We can, let's hold off on the screen share, and I'll give you my hypothesis afterwards. Sure.
So it seems like the distinction you make between whether there was an imbalance building up before the crisis versus there was not an imbalance is the most important distinction, more important than demand versus supply distinction of the crisis. And also more important, like Alan Blind, I want to know the oil price shocks. You didn't mention oil price shocks or anything like that.
Yeah,
elaborate on this a little bit.
Yeah, let me say that. I mean, it's true that oil price shocks were behind the 74, 75 recession and the 79, 82 because they drove up the rate of inflation. And so the Fed was intervening to contain what it thought were wage price spirals. But I don't think either of those recessions, although there was a supply shock which drove up the inflation rate, the recessions themselves were driven by the demand side effects of rising interest rates. And so I don't think that yes, they were aggregate supply shocks, but the mechanics of it actually worked through the demand side. And part of the issue there was that there was a lot of indexation in the U.S. economy back then, so that shocks to CPI through oil prices fed through into wages and prices of non-oil goods. But I don't think I really think the important distinction is not supply versus demand. And I think if you go back further, we can probably find more examples. I would argue anyway that the important question is really whether the shock is actually, I'm going to say that in the next slide, whether the shock is really external in a sense, in a weird sense, but the Federal Reserve is raising interest rates, and it may be doing so because it's worried about the inflationary impact of an oil price hike. But the Fed raising interest rates, as opposed to recessions that come about for internal reasons because of the accumulation of unsustainable investments or debts by the private sector. Okay. Yeah, so actually let me try that. We'll see if I can figure out we're all experimenting a bit with technology. Yeah. So there's the argument. My hypothesis is that the difference in the shapes of recessions, or actually in the speed of recovery, is not fundamentally about whether it was interest rates or a financial crisis. So Reinhard Rogoff was saying financial crises are different. I was arguing that it was not, just more broadly, that private sector overreach crises are different. But it's about whether the headwinds are externally or internally generated. And if they are, if that is the right distinction, and that's what I'm arguing anyway, then the COVID slump could be more like 1979-82, which was followed by Morning in America, a very rapid recovery, than like 2007 to 9, where the overhang of debt and of excess construction of housing bedeviled the economy for a long time. As everybody knows, there's other things in there. There's premature austerity and lots of other things. But if that distinction is right, the economy could come back very rapidly if the viral threat is lifted. I'll give you some possible alternative arguments in a bit, but just to say, even that right there, that's a very big if, and for what it's worth, the markets are not convinced. But then that question is what we should learn from that. So just for a second about the viral side. We all have access to the same material. The epidemiologists I actually wish we had something like the Booth School panel on epidemiology, where we could identify what the actual consensus of the profession is. But so far as I can tell, the epidemiologists are all of the view that that we do not have this thing under control, that social distancing has flattened the curve, but that in the United States, at least, we're nowhere close to the point where any major reopening can take place without high risk of a second wave of infections. They might be right, they might be wrong, but epidemiology is a technical field and not one we know, so we should take that seriously. And I'm sorry, I can't resist, but how not to predict everybody probably knows the Council of Economic Advisors got into the act fitting a cubic model to the cubic time trend to the data. And now they claim they weren't projecting, but that dotted line at the bottom sure as hell looks like a projection. And of course, given that, there are no deaths today right? It's not, we're amateurs on this. We should trust the epidemiologists. They might be wrong, but they'll be wrong because this is an inherently difficult subject. By the way, one which involves human behavior as well as complex systems. So it's actually not, it's got many of the same uncertainties that economics has. But it's a, so even if we could be having a rapid rebound once the viral threat is lifted, the question of when that will happen is still not very much up in the air. I mean, and it all depends a lot on whether the epidemiological response is adequate. If I were going to go for the W-shaped, my baseline is the Nike swoosh, but if we were going to have a W-shaped, it would be because we open up prematurely and the virus starts to explode and we lock down again, rather than because of some inherent economic arguments, although there might be something there as well. The other thing to say is that interest rates, long-term interest rates, the stock, never mind the stock market, everybody knows the Paul Samuelson. The stock market has predicted 9 of the last 5 recessions, and beyond that, actually the impact of projected economic activity on stocks is ambiguous, because higher growth means higher future profits, but also probably means higher interest rates because the Fed will tighten eventually, and so it's not at all clear. I mean, probably the stock market goes up when people are more optimistic about growth, but it's not clear at all. That's certainly not a very clear, but the bond market ought to be telling you what people expect about future growth. If people expect a recovery that will bring us close to capacity and which will cause the Fed to tighten, then long-term interest rates should rise. And if people expect a slump that goes on forever, then you'd expect long-term interest rates to be low. And long-term interest rates are very low right now. They're real interest rate on 10-year is -0.5. The nominal rates are a third of what they were at the beginning of the year. The market is implicitly forecasting a slow, long recovery process. The market is pessimistic, does not believe that we can come springing back in effect. So, which is something to be taken seriously. However, markets are great, but they can be wrong. So just, there was a huge rise, there was a sharp rise in long-term interest rates in the first half, actually, of 2009, which, by the way, if you read financial reporting, there were an enormous number of newspaper articles that said that interest rates are rising because of debt fears, which was simply stated as a fact, not a hypothesis. And in fact, there was no reason to believe that was what was going on. What was happening was that people were, by and large, once the economy turned the corner, once the green shoots of recovery began to appear, they were predicting. They were basically, the market was into the plucking model and believed that the economy was going to come roaring back, and long-term interest rates reflected that. It turns out to have been wrong. We did not have a V-shaped recovery from the 2008 crisis. Now there is a question, and it does bear a little bit on this, of whether Marcus talked at the beginning about shift in the long-term growth trend. Maybe shift, there's substantial evidence that there's been a structural shift in long-term interest rates, that we are and short-term interest rates, well, that secular stagnation is a major concern. And people may not have believed that before 2011, 2012. It took them that long to realize that maybe this is kind of a permanent thing. That's also, by the way, a question that overhangs issues about the shift in the growth trend. How much of that is because of the effects? I mean, how much of that is hysteresis, the effects of the crisis, and how much of that is that actually we were fated to have a decline, but people were fooling themselves beforehand. But in any case, my point is that the fact that the market is acting as if we're not going to have a rapid recovery is useful, but it's not dispositive. The markets have been really quite wrong before. Yeah.
Check another question. So Jeffrey Frankel would like to know, are there any inflationary, so given that all policy measures will contain the Keynesian demand problems which might arise, do you fear there's some inflationary pressures building up, or in the long-term interest rate being so low indicates the market believes there's more deflation danger than, so what's your take on the deflation side?
Yeah, the question would be whether, here's how I put it. First of all, the monetary side, the zero interest rate world, don't care about the monetary base isn't telling you anything. We're doing quantitative easing on a huge scale, although I would say that for those who are into this, this looks more like QE1 than QE2. QE1 was the initial large-scale intervention to basically plug the holes in collapsing markets. And that's really what we're doing here, and that's surely not inflationary. There's a question about whether fiscal stimulus could be overdone. That seems, I mean, I would say that actually there is a question. If you go back to the Gutierrez et al. Paper, you see that there is a possibility that depending upon intersectoral and intertemporal elasticity of substitution, that you end up driving up the prices of goods that are still available. But on the other hand, they could go down, and that's even if you fully compensate the people who are unemployed. At the moment, however, I would say that we're falling sufficiently far short of complete replacement of income, and the substitutions don't seem all that big. That it's certainly a possibility. I think Olivier has said that he's not. It's conceivable that we'll have inflation as this, but that's not his base case, and I'd be in the same position. That the overall we're probably still some net Keynesian drag on demand, despite all of that. And I would actually point out that among other things, that these compensatory programs are time limited. I would say too time limited, but the enhanced unemployment benefits expire on July 31st. The special business lending program actually only provides, they can only be converted into grants for 8 weeks. And the US state and local governments. And one of the things about that jobs report last week was that the state and local governments account for 1 million job losses already. And there's considerable pressure. So I would say no, I'm not really thinking of inflation as a risk, though it's not in principle impossible, but it doesn't look like it's out there. And the market is telling us that expected inflation as measured by the spread on index bonds has gone down substantially. That may or may not be right, but it's not what I'm really concerned about.
So if I may summarize, tell me whether I'm wrong. So you believe in the bond market with regard to the inflation expectations, but you believe more the stock market and with regard that we have a more optimistic recovery rather than.
I don't think the stock market is telling us about the pace of recovery either way.
Okay.
I think the stock market, if you look at the stock market, it very closely tracks the spreads on risky bonds. Basically, the stock market plunged as the incipient financial crisis emerged, and both the spreads between BAA and high yield bonds and corporate bonds and treasuries, everything turned around on March 23rd, and the stock market came back, making up much, though by no means all of its losses. I don't think the stock market is telling us much about the recovery, and I don't actually. I'm not sure I believe the bond market is actually quite pessimistic. It's actually not simply saying that inflation will not be a problem. It's saying that inflation will be substantially lower than it previously expected. And I actually don't think I'm not sure I believe that, but also it's not clear that it is reflecting, I kind of say, complicating factors. I'm actually somewhat pessimistic about the actual pace of recovery, but not because of the economics, but because of the epidemiology. Actually, that's all my slides, but let me just say a few more words. And so what may I be missing here? First of all, everything depends upon the epidemiology. And if it's really going to continue a descent, if opening does not cause a significant rise, then I would believe that a quite fast recovery is possible, subject to the things I'm going to talk about in a minute. But doesn't. I personally have become a lot more pessimistic about that, but that's only because I'm listening to the epidemiologists, and because our government does not seem to be listening to the epidemiologists. And so, and for what we've seen, for what it's worth, international experience has been that countries that have been far more successful at containing COVID-19 than the United States, like Germany or Hong Kong, not Hong Kong, they haven't had the problem, South Korea, once they began opening, they did tend to have new outbreaks. And we may get some information on that quite soon, because that apparently people are jamming into the bars in Wisconsin, and in about 2 weeks we should have some notion about what that is doing. The thing that I'm, I guess, most concerned about in terms of that, have I got this wrong, involves whether the lockdown is itself inflicting substantial structural damage. And that's kind of this severing relations of employees with their employers, and takes a while to reestablish those. Businesses, particularly small businesses, large businesses can do Chapter 11s, probably not liquidate in most cases, though not always, but small businesses that simply cease to exist. So once people are willing to go back to restaurants or able to go back to restaurants, maybe there are no restaurants, that sort of story. Jerome Powell's testimony to Congress was very heavy on the structural damage issue. He was basically, aside from pleading with Congress to provide more fiscal relief, he was in effect warning that if it does not, that there will be a lot of hysteresis, that there'll be a lot of structural damage to the economy. As far as I can make out, he didn't really say that, but I think we should be thinking about not just businesses that go under and take a long time to reestablish, but also household balance sheets could end up being stressed because during the lockdown, to the extent that, particularly actually, if the unemployment benefits that have made such a big difference so far, if they expire when the economy is still in a virus lockdown, then you could see people with households with depleted savings, much worse in balance sheets. You could see a lot of firms that have borrowed to try and stay afloat and then are crippled by the debt, even if they didn't fail during the initial period of lockdown. So there may be some other stuff going on there that is not really, I don't think we've managed to model. But for what it's worth, I'll just say one last thing. In saying that I thought we could probably have that this is more like 79-82, and that a Morning in America style recovery is more possible than people think. That's not what I want to. For what it's worth, my biases, both character and political, lean the other way. That is, I tend to be a pessimist on these things, and I also kind imagine the idea that the US economy might be roaring back just in time for November is not something that makes me particularly happy. But but it is, at least my read of it is that if you think about it in terms of the fundamental question of what causes a recession determining what the shape of the recovery is, that this is more like the tight money recessions that preceded the Great Moderation. It is like the private sector overreach recessions since the beginning of the Great Moderation, and then and that therefore we are better poised than many people think for rapid recovery. End of.
Thanks a lot, Paul. It's a great hypothesis. I really like it. It's very optimistic. And I would like to know, how would you test this hypothesis? You could probably look across countries where saying, well, some countries, if I summarize your hypothesis, if policies are right, we might have a sharp recovery, a very fast recovery, conditional that the virus component is also taken care of. But we could test this across countries. There are some countries who have other different policies. Or would you say the correlation, the interconnections in the international global economy is so tight that there's no way to really test this?
No, I would think I would think that we would want to look hard at countries that have been more successful. Well, how fast is there is a list of countries that appear to have been quite successful at containing, and South Korea, China, actually, although no one actually really trusts their data, but nonetheless, the fact is they follow the draconian control procedure, and New Zealand. So we will want to be watching those. Now, as we've seen, there has been some virus rebound in some of these countries, but I would particularly be interested to see with South Korea. They had obviously an enormously more successful control program than we have had, and although they have had a partial resurgence, although they caught it very quickly, so they ended up closing bars and nightclubs. So but on the whole, they're still in the process of reopening. Now the question might be, South Korea being an extremely open economy, how much of an independent recovery can they have? But I still think you'd want to be looking at that. So, and Germany, much bigger economy, also rather tightly integrated into the global economy, but Germany is clearly much further along in this than the rest of us are. So keep an eye on whether these countries can have rapid recoveries. I have to say the very, very early anecdotal evidence from China is not too favorable to my hypothesis, but it's very, very early. They've been opening up, but consumer spending is still very depressed, and so but it's very, very early days.
So I have a number of questions from the audience, which are more policy related, less to your grand hypothesis. And in particular, people are asking, should we give subsidies to employers or employees? What's your take on that? Do you like the Danish approach versus the US approach on that? And with regard to short-term work or this Kurzarbeit concept, what's your take on this, if it turns out to be a longer lasting crisis?
Yes, okay. My views on that are muddled, but because I think that, broadly speaking, there's a North American approach and there's a European approach. It's not totally right, but think of it that way. And the North American approach is enhanced unemployment compensation, and the European approach is wage subsidies to keep people employed. And now the US, it's not pure. They have had unemployment benefits as well in Europe, and in general have much better replacement of income than we do. And the small business lending, the PPP program, is with loans that turn into grants if you can show that they were used to meet payroll. It's kind of like a European thing, but that program has been something of a disaster. North American approach and the initial parts of the North American approach didn't work too well here, although there was a much more successful opening stage in Canada, which actually has the enhanced unemployment benefits similar broadly to what the US is doing, but instead of running it through state unemployment offices that have computers that run on COBOL, established a federal web portal and hotline, and people were able to get the benefits within days. But the US one is kicking in now pretty seriously. The disadvantage of the American style one is that if workers lose their relationships with their former employers, it may be costly and time consuming to reestablish them. The disadvantage of the European style program is that it presumes that the post-COVID economy is going to be pretty much the same as the pre-COVID economy. And if we are in fact going to experience a lot of induced structural change with more delivery, more remote conferencing, all of those things, then you actually want to divorce the relief payments from the previous job. So the principle in either case is that you want to largely hold people harmless from the economic impact of the lockdown. It's not really stimulus; it's really disaster relief. But then the question of whether it's kind of this flexibility issue. The North American style one creates maximum flexibility, but possibly disrupted relationships. The European one maintains the relationships, but has less flexibility. And I don't think we know the answer to which one is going to turn out better. And the Kurzarbeit, again, if extended hours, short hours and job sharing so that people remain employed in a vastly shrunken travel and hospitality sector is great if you think that travel and hospitality is going to come roaring back to where it was. But if you think that this whole let's get together for conferences by having everybody fly in from all over the country is going to be a persistently much smaller thing now that people have learned how to use Zoom, then it's not such a great idea. So I'm not sure that one is better than the other. I think we don't know.
Thanks. So let me close with a final question, because there are a lot of questions about emerging economies, and we haven't touched upon the emerging economies. Do you have a particular message? What should policymakers in emerging economies consider in particular? And everything in 2 minutes.
Yeah, no, it's just, I'm just starting to get my act together. Let me say that as I read it, I talked about how the financial spillovers have been contained. That's mostly true for OECD assets. The Fed has gone to incredible lengths saying it's willing to buy junk bond ETFs. It has not said that it's willing to buy emerging market debt. And I think presumably it can't. The Fed can't. The Fed would face political hell if it did that. And God, I mean, the ECB probably can't even buy Southern European debt at this point. So so I actually am concerned that we may have, for emerging markets, a much more traditional sort of financial crisis. And I'm still trying to figure out things have changed a lot in emerging markets since the late 90s, whereas where a lot of us got our baptism in this. The original sin, inability to borrow in their own currency, is no longer a big consideration in many of these countries. But how much latitude does that give them? And the answer is I don't know. And I will probably try to figure that out within the next 2 weeks, because that's probably the next but one session of Krugman Today.
Fantastic. So I recommend everybody to zoom in Krugman Today in 2 weeks to learn more about emerging economies. Thanks again, Paul. It was fantastic to have you here and for providing this big hypothesis. I think that's good to have, a clear message. And hope to see you soon here in Princeton. Okay. Hope to see anybody soon in Princeton. All right. Or anywhere else. Take care all. Thanks again. Talk to you soon. Bye.